Hello, my dear students. Today, in ICI mock test paper 1 for September 2025 attempt, whatever the answers given by ICI, for those answers, I am going to give solutions for you in this video. So, I welcome you all for today's discussion on September 25 mock test paper 1 for direct taxation. So, for all these MCQs, answers are given by ICI. But how these answers came, that I am going to reveal to you in this video. Okay. First, Mr. Suras, aged 38 years. He is working in Kareem Private Limited as an assistant manager, finance. His yearly pay slip for financial year 24-25 is as follows. Basic pay, dearness allowance, HRA, transport allowance, personal allowance, children education allowance, medical allowance, bonus, employees contribution, profession tax, income tax, net pay. His employer also contributes equivalent amount. See, employer contribution up to 12% it is exempt. In excess of 12% it is taxable. Okay. He has paid 55,000 to 12 towards medical premium for his parents. See, his parents are 65 years old, right? So this is allowed up to 50,000. This is allowed up to 50,000. Next, he has 3 children studying in Sandalwood International School. The following are components of school fees paid for academic session 24-25. See, under 80C, tuition fees paid is eligible for deduction, but only maximum for 2 children. So, only this component, tuition fees, is allowed. Remaining components are not allowed. That too only for 2 children. So, it is beneficial to take 37,000 and 40,000. Total 40 plus 37, 77,000. Next, Suraj deposited 2 lakh in bank account of his minor child 1, 3 lakh in bank account of minor child 2, and 4 lakh in account of minor child 3. The bank paid interest at the rate of 3.5% per annum on each of these deposits. All these transactions were made on 1st April 2024. He has invested 5,000 in HDFC ULIP and taken LIC policy for his wife for 10,000 rupees. He invested 12,500 and 25,000 towards NPS Tier 1 and Tier 2. These are also eligible for deduction under ATC. He donated 50,000 in PM Cares Fund, eligible for deduction under ATC. 50% deduction is only eligible. Next, Suraj invested 40,000 in listed equity shares of 3 India Limited on 1st March 2020 at the rate of 200 per share. On 31st December 24, company bought back his 100 shares. See, recent amendment in Finance Act 24, buyback of shares, it will be treated as deemed dividend under section 222F. How much? 100 shares into 300 per share. 100 into 300. 30,000 will be considered as deemed dividend and it is taxable under the head income from other source. From this information given above, choose most appropriate answer to following questions. Which of the following statements is correct regarding allowances received by Mr. Suraj if he has opted out of default tax regime? See, opting out of default tax regime means paying taxes under optional tax rates. So under optional tax rates, medical allowance and children allowance are fully, see, children education allowance is not fully exempt. Children education allowance is exempt up to 100 rupees per month. All allowance received are fully taxable. This is also not correct. This is not correct. Only transport children education allowance 100 rupees per month exemption is available. This answer is also not correct. That means this answer is correct. Children education allowance is exempt up to 100 rupees per month for a maximum of 2 children. Next, what would be the amount of income chargeable to tax under the head salaries in the hands of Mr. Suraj? See, hmm, basic pay is taxable, dearness allowance taxable, HRA taxable. Hmm. If he pays tax under default tax regime, HRA exemption is not available. So HRA is fully taxable, transfer allowance fully taxable, personal allowance fully taxable, children education allowance, medical allowance, bonus fully taxable. See, 1,14,132. Employer also contributes the same, right? So how much is employer contribution? 1,14,132. Out of this, 12% is exempt, greater than 12% it is taxable. The 12% of basic pay plus dearness allowance. How much is basic pay? 6,34,068 plus dearness allowance 126,814. How much? 7,60,882 into 12%. How much? 91,305. So 91,305 is exempt. How much is balance? 22,826. So add all these six items. Add all these. How much? 16 lakh 53,210 plus 22,826. 16 lakh 76,036. From this standard deduction is available, right? Under default tax regime, standard deduction available is 75,000. So 16 lakh 1,036. That is the answer. This is the answer. 16 lakh 1,036. Determine amount of tax to be deducted at source by Kareem Private Limited on salary paid to Suraj under default tax regime if he has not informed about his other income. See, how much is total income? Salary. Salary is 16 lakh 1,036. On 16 lakh 1,036, what is tax liability under default tax regime? Do the calculation. Up to 3 lakh nil. Greater than 3 lakh up to 7 lakh, tax rate is 5%, tax amount is 20,000. Above 7 lakh up to 10 lakh, tax rate is 10%, tax amount is 30,000. Above 10 lakh up to 12 lakh, tax rate is 15%, tax amount is 30,000. Above 12 lakh up to 15 lakh, tax rate is 20%, tax amount is 60,000. Above 15 lakh, tax rate applicable is 30%. So 16 lakh 1,036 minus 15 lakhs in how much it? 30,311. So total 1,70,311. To this we need to add HEC at the rate of how much? 6,082. 1,77,001. So this is the answer. 1,77,120 rounded off. Fourth, assuming for the purpose of answering this question only, that means only for this question, that no contribution is made by Suraj and his employer towards Provident Fund what amount of deduction is available to Suraj under Chapter 6A for the previous year 24-25. So Chapter 6A deductions, we like here assumption is employee contribution to provident fund is not done. So this is not eligible for deduction under ATC. Under 80D, deduction available is 50,000. Next, ATC 77,000. So, under section ATC 77,000. This is for children. Next, 5,000 ULIP was taken for his wife. That is also eligible. 15,000 is eligible. Next, 12,500 plus 25,000. How much? 37,500. So how much is total till here? 1,29,500. 80D 55,000 to 12, but it is restricted to 50,000. Next, PM Cares Fund 50% is eligible for deduction. ATG 50,000 into 50%, 25,000. See, this is interest on savings account that is eligible for deduction under 80 TTA. How much? 2 lakh into 3.5%, 7,000 minus 1,500, because 1,500 exemption is available while clubbing minor children income. So 5,500. 4 lakh into 3.5%, 14,000 minus 1,500, 12,500. Three lakh into 3.5%, 10,500 minus 1,500, 9,000. So it is eligible for deduction under 80 TTA, right? 80 TTA deduction available is 10,000. So total 10,000 plus 25,000 plus 50,000 plus 129, 2,14,000. Yes, this is the answer for B. Next, what amount of interest income will be included in total income of Mr. Suraj? Suraj, if he has opted out of default tax regime, see, if opted out of default tax regime, then 1,500 exemption is available, correct? How much is total interest? 9,000 plus 12,500 plus 5,500, 27,000. So this is the answer. Next, what will be the tax treatment of buyback of shares? See, buyback of shares is taxable as deemed dividend under section 222F that we have discussed now. 30,000. Next, second question. Raman, aged 64 years, was not able to provide satisfactory explanation to assessing officer for investments of 7 lakhs not recorded in books of accounts. What shall be tax payable if it is considered as deemed income? 78% tax is applicable. So 7 lakh, we have discussed section 115 BBE. 7 lakhs into 78%, how much? 5 lakh 46,000 is the tax liability. Next, which of the following statements is true regarding liability to pay advance tax? Advance tax is payable only if total income exceeds basic exemption limit. No, advance tax is payable if tax liability is 10,000 or more. Advance tax liability arises only for those who have income from business or profession. No. Rakesh and Sons AHF has to pay advance tax if advance tax payable is 10,000 or more in a financial year. This is correct. Next, descriptive questions. Subhash, a manufacturer and distributor of fertilizers and other agricultural products, aged 61 years. See, his age is more than 60 years. Provides following information for assessment year 25-26: sales, closing stock, opening stock, purchases, direct expenses, right inward, salaries, general expenses, rates and tax, interest on late payment of GST that is allowed as deduction, income tax paid, whether income tax paid is allowed as deduction, no, this is to be disallowed. Interest paid to NBFC that is allowed as deduction. Wait, additional information is available. Based on that, we have to take decision. Depreciation. Dividend from Indian companies. This is taxable under IFOS. It should not be credited to P&L account. So this is to be disallowed while calculating PGBP income. Next, interest received on FDs. This is also taxable under IFOS. That should not be credited to P&L account. Rent received, this is taxable under house property. It should not be credited to P&L account. Another important point, rent received was given. So this is gross annual value. From this you should claim 30% standard deduction. Then you will arrive at income from house property. Okay. Income tax refund, this is not taxable at all, but it was credited to P&L account. It should not be credited to P&L account. Okay. Next. Additional information, turnover of Subhash, closing stock of 24-25 undervalued. See, it is undervalued. To rectify, what we need to do, we need to increase closing stock by 25,000. When closing stock increases, net profit also increases. So net profit also increases by 25,000. Are you able to understand? Rates and taxes include 5,000 paid towards late filing fees of his income tax return. See, interest on late filing fees, that is not allowed as deduction. That is to be disallowed. Salary include 15,000 paid on a single day by way of cash. See, this is also disallowed as per section 40A3. Total 15,000 is to be disallowed. Interest paid on loan 10 lakh. Loan of 10 lakh taken from NBFC. Out of loan 2 lakhs was used for personal purpose. See, if any amount is used for personal purpose, interest on such amount is not allowed as deduction. Correct? So how much is loan taken? So out of 10 lakhs, 2 lakhs is used for personal purpose. For 10 lakhs, how much is interest paid? Interest paid is 1,20,000. Correct? So for 10 lakhs, 1.2 lakhs interest was paid. For 2 lakhs, how much it will be? You can do cross calculation. 24,000. So 24,000 is to be disallowed. How much is balance interest? Balance interest is equal to 1.2 lakh minus 24,000. 96,000. On this 96,000, no TDS was deducted. As TDS was not deducted, 30% is to be disallowed. 96,000 into 30%, 28,800. So total 28,800 and 24,000 is to be disallowed. Subhash paid 45,000 by check during the year towards health insurance premium for himself, spouse and children. See, Subhash is aged 61 years, right? So he can claim deduction up to 50,000. So this 45,000 is allowed as deduction, but only under default optional tax rates. Under default tax rates, section 80D deduction is not available. Next, general expenses include an amount of 20,000 paid by check towards an advertisement published in political party. See, this is advertisement expenditure. This is not a business expenditure. So it is not allowed as deduction. Moreover, SSE is individual. So whatever the advertisement expenditure is there, that is also not allowed as deduction under 80 GGC. Okay. He received income tax refund, which includes 2,000 interest. 2,000 interest on income tax refund that is taxable under income from other sources. Depreciation charged is as per income tax rules. However, it does not include depreciation on new machinery purchased and put to use on 23rd September. So cost of vehicle is 3,10,000. So on this, how much will be depreciation? 3,10,000 into 15%, 46,500. Advance tax paid, that is not allowed as deduction. So these are the adjustments. You can go through the answer. It will be easy only. Next, Rohan furnished the following particulars of his income for the year ended 31st March 2025. Income earned from business in iron, which is controlled from Delhi. So, 65,000 is received in India. See, whatever income received in India, it is taxable for all. So, for ROR, RNOR and non-resident, 65,000 is taxable. But business is done in Iran, it is controlled from Delhi. It is foreign income. This type of foreign income is taxable for ROR and RNOR. So 15,000 is taxable for ROR and RNOR. For non-resident, foreign income is not at all taxable. Pension for services rendered in India. See, services are rendered in India. Place of accrual is India. So it will amount to Indian income. If it is Indian income, it is taxable for all. ROR, RNOR as well as for N. Next, dividend from oil company, an Iran-based company. See, Iran-based company means it is foreign income. Foreign income is taxable only for ROR. It is not taxable for RNOR and non-resident. Next, interest on money borrowed by Mr. Deepinder, a non-resident, for the purpose of investment in shares of XYZ Limited, an Indian company. For investment in India, loan was taken by non-resident. From non-resident, interest income was received. So, see this type of income, uh, it is taxable only in hands of ROR. It is not taxable in hands of RNOR and non-resident. See, whatever the money borrowed from Rohan is there, that money is used by non-resident for the purpose of investment in India. But it is not Indian income. That money was not used in India. That will be treated as foreign income. Foreign income is taxable only for ROR. Next, examine and explain TDS or TCS implications in following cases. Ram, an individual carrying on business, reported a turnover of 89 lakhs in financial year 23-24. That means in preceding financial year, turnover is less than 1 crore. In April 24, he entered into an agreement to hire machinery for use in his business operations for a monthly rent of 50,000 rupees. See, in preceding financial year, turnover is 89 lakhs, which is less than 1 crore. Moreover, why 50,000 rent is required to be paid? See, generally on payment of rent, TDS is required to be deducted under section 194I. But 194I is not applicable because in preceding financial year, turnover is less than 1 crore. So in this case, which section gets attracted? 194M gets attracted. But 194M speaks only about rent on immovable property. Here rent is on machinery. So 194M is also not applicable. 194M is applicable only in case if rent is paid on immovable property. Next, XYZ Limited having idle parking lot opted to lease. See, generally in case of leasing of parking lot, section 206C 1C gets attracted. As per that, 2% TCS is required to be collected. But here it is leased to public bidding process. PQR Limited, a public sector undertaking, emerged as a highest bidder. See, whenever parking lot is given on lease to a public sector undertaking, no TCS is required to be collected under section 206C 1C. See, cleverly, intricate points are being asked by ICA. Next, give me 1 second. Next, Merces Aditya Traders, a sole proprietorship concern, owns 4 machines that were first put to use for business purpose in March 24. The depreciation on these machines is charged at the rate of 15%. Now, written down value of the block as on 1st April 24 was 7,70,000. On 15th July, 2 old machines were sold for 10 lakhs. On 30th December, it acquired a second-hand plant and machinery for 6,10,000 and put it to use for business purpose. So we can calculate depreciation. How much is opening written down value? Opening written down value is 7,70,000. To this, we will add additions. How much are additions? 6,10,000. From this, we are going to reduce sale value of assets sold. So, assets are sold for how much? Assets are sold for 10 lakh. 7,70,000 plus 6,10,000, 13,80,000. From this, we are going to reduce 10 lakhs. So, how much is written down value for depreciation? 3,80,000. And this 3,80,000 on LIFO basis allocated to 6,10,000. So on this, we will provide only half rate of depreciation because it was purchased on 30th December 24. So depreciation will be 3,80,000 into 15% into 1 by 2. 28,500. The amount of depreciation is 28,500. Wait, let me check the answer. Yes. Then capital gains 0. If there is depreciation, there is no concept of capital gains. If Aditya Traders sold the two old machines for 15 lakhs. Will there be any difference in your workings? Yes. See, if they are sold for 15 lakhs, in that case, how much will be the opening written down value? Opening written down value 7,70,000, 6,10,000. Total it will be 13,80,000. If they are sold for 15 lakhs, then we will write off total. In that case, sale value is 15 lakhs. From that, we will reduce cost of acquisition being opening written down value plus additions. How much is opening written down value plus additions? 13.8 lakhs. So how much is balance? 1,20,000. That is taxable as short-term capital gain. Okay. Mr. Arjun and Rohit started constructing independent residential houses on a plat of land situated in Delhi. Each house comprises a ground floor and first floor, having built up area of 1800 square feet each. Mr. Arjun commenced construction on 1st April 2022 and completed it on 1st April 2024. He occupied entire house for his personal residence from date of completion. Rohit also commenced construction on 1st April 2022 and completed it on 30th September 2024. So, in these cases, we need to calculate pre-construction period interest. See, entire house for personal residence. That means total house is self-occupied property. Okay. He occupied ground floor from 1st October 2024. So in case of Rohit, ground floor is self-occupied property. First floor is let out at a monthly rent of 20,000 for the period from 1st October 24 to 31st December 24. The tenant vacated the premises on 31st December 24. So, and Rohit occupied entire house. See, first floor on 1st October 2024, it was ready for occupation. Till 31st December 24. That means 3 months hardly. October, November, December. For 3 months, it is let out property. For another 3 months, till 31st March, it is self-occupied property. So for whole 6 months, it will be treated as deemed to be let out property. Okay. The following additional information is provided. Fair rent, municipal value are given. Municipal taxes are paid. So as municipal taxes are paid, they are allowed as deduction. Repairs and maintenance expenses. Repairs and maintenance expenses are not allowed as deduction. Housing loan availed. This you can use for calculation of pre-construction period interest and current year interest. No principal repayment was made. You are required to compute income from house property of Arjun and Rohit if they opt out of default tax regime. Opting out of default tax regime means they are paying taxes under optional tax rates. So accordingly, you can calculate in case of Mr. Arjun, as it is self-occupied property, only interest will be allowed as deduction. In case of Rohit, ground floor self-occupied property, only interest will be allowed as deduction. As it is deemed let out property, you need to calculate total income. So let us quickly go through the answer. Yes. Here you can see in case of Arjun, pre-construction period interest is calculated and current year interest is also calculated. Total it is 2,52,000. See, even though it is 2,52,000, as it is self-occupied property, maximum deduction allowed will be 2 lakhs, correct? So only 2 lakhs will be allowed as deduction. Total interest will be treated as loss from self-occupied property. Ground floor, first floor. Ground floor self-occupied property, only interest is allowed as deduction. You can go through pre-construction period interest calculation. And as first floor is let out, see, first floor is deemed to be let out property. In gross annual value calculation, in step 3, generally we will compare actual rent minus unrealized rent with expected rent. But here we do not do that comparison. Gross annual value is equal to actual rent minus unrealized rent or expected rent, whichever is higher will be taken as gross annual value. Okay. So accordingly, you can do this calculation. Next. On 14 June 24, Rajesh Kumar gifted sum of 3 lakhs to his brother's wife, Neha. On 12th July 2024, Rajesh Kumar's brother gifted 5 lakh to minor son of Mr. Rajesh Kumar. Both Mrs. Neha and minor son invested the gifted amounts in fixed deposit on 1st August 2024. See, this is concept of cross transfers. So in case of cross transfers, whatever the common amount is there, to the extent of common amount, whatever the income on common amount is there, on common amount, whatever the income is there, that will be clubbed. Okay. But here minor son is there. In case of minor son, not common amount, total income will be clubbed in the hands of parents. Total income will be clubbed in the hands of parents. But at the time of clubbing, 1500 exemption is available. Okay. What would be your answer if Rajesh Kumar's brother gifted 5 lakhs to Mrs. Anjali? See, in case of cross transfers, if there is no minor, then only to the extent of common amount clubbing provisions will get attracted. If there is minor, then in case of minor, not to the extent of common amount, total income will be clubbed in the hands of parents. Okay. Next. Examine with reasons whether quoting of PAN in following transactions is mandatory or not. As per provisions of Income Tax Act 1961, Arjun makes cash payment of 50,000. See, if it is more than 50,000, then PAN is required to be quoted. It is exactly 50,000 here, so PAN is not required to be quoted. Kavita enters into a contract for purchase of debentures. See here, value of debentures is more than 50,000. So PAN is required to be quoted. Ramesh makes a payment of 57,000. Again, it is more than 50,000. PAN is required to be quoted. Neha makes a payment for purchase of immovable property. See, out of these two, whichever is higher, it is 9,75,000. It is less than 10 lakhs. So PAN is not required to be quoted. Next, Mr. Sahid, an individual who is ROR in India, has earned salary income of 8,25,000 during financial year 24-25. He is eligible to claim deductions under ATC, ATD, ATG amounting to 2,75,000. On 30th July 2025, he approaches you for assistance in filing return of income. As a tax consultant, what would be your advice regarding filing of his return of income? See, 8,25,000. How much are chapter 6A deductions? 2,75,000. See, from salary income, 50,000 standard deduction is available. Balance 7,75,000. So if you claim chapter 6 deductions, total income will be exactly 5 lakhs. If it is exactly equal to 5 lakhs, then he can claim rebate under section 87A. Thereby, his tax liability will be 0. So it is better to choose optional tax rates so that his tax liability will be 0. As a tax consultant, what would be your advice regarding filing of his return of income. See, generally default tax rates are applicable. If he approaches me on 30th July, I will make him to shift from default to optional tax rates, and thereby his tax liability is zero. But if he approaches me on 1st August, default are only applicable. He cannot shift from default to optional tax rates. You know, right? If SSE wants to shift from default to optional tax rates, he need to exercise such option before ITR due date under section 139(1). So ITR due date is 31st July. Maximum till 31st July, he can shift from default to optional tax rates. If he comes to me on 1st August, I cannot help him. Okay, he need to pay taxes under default tax rates. His tax liability will be there. Okay, so this is all about explanation of MTP1 for September 2025 attempt. I hope it is useful for you. If it is useful, please share with your friends. Okay, thank you.